Let's take another call right now. Carl in North Vancouver, go ahead.
David, I bought Google year 2009. Cost is 160 per share. That is bargain hunting. And my question is now it's time to sell because GOGC looks expensive. Please suggest me. I hang up and listen.
Well, Carl, first of all, if you paid $100 and something for Google, congratulations. That's a wonderful story. It's been a great performer. We own Google, and I would buy it today.
Okay.
We like to own things that have a secular or long-term tailwind. They are dominant in advertising on the web and search, of course, and in the cloud. And so these are all high-growth areas. They'll continue to grow. Stocks hanging in particularly well relative to the market, is trading better than 75% of the stocks in the market so far this year. And if they can continue to generate cash and generate growth and be dominant in these long life trends, I think you want to own the stock.
David, you know, people seem to always love this stock, and we don't end up talking about the risks. And maybe at this point there aren't enough to talk about, but what do you say to that? What are the risks here?
Look, there's always risks, and so here's our premise. If we can find sectors of the market, first of all, that people care about now, and they're performing well, and then you can find stocks that are performing well relative to their peers from a price perspective. That's just purely technical. And if you can find those that have fundamental characteristics in the income statement and the balance sheet that put them as premium to their peers, then that's a great place to start.
Okay.
And then there's always going to be things to worry about. So what I'm going to watch is if the numbers start to deteriorate, one, or two, if price stops behaving the way it should be, given what we think we know. So there's always risk of disruption in technology. But the markets that they're in are growing so quickly, and there are such high barriers to entry, it's hard to imagine right now how somebody can unseat them. But that's why it's one of 40 positions in our equity portfolio, because it can happen, and that's why we have stop losses, because it can happen. You'd never want to put all your money in one or two stocks, and of course you wouldn't want to do it here either.
But the recent issue was surrounding the ad revenue for the quarter, if I recall correctly. It feels like a long time ago, but a lot of these big cap tech companies didn't do that well.
Well, when you think about it, you know, it's a very quickly growing market, and there's lots of change. Facebook is doing a great job. We also own Facebook. So, you know, one of the things that you can do is own a basket of these things. So you could buy Google, and you could buy Facebook, you could buy Amazon, or you can go out and buy PNQI, which is the ETF that holds the basket, or FDN, which holds the basket of internet retail, and participate in all of them and just say, I want to be part of this theme. And I do both. We run a macro portfolio, only invests in ETFs, and just takes targeted bets and investments in specific sectors or themes.
Okay. Let's take another caller right now. Bernard in Cambridge, Ontario. Go ahead.
Hi, David. Do you see any upside for Cameco? And can you touch on the price of uranium to see if it's going to go higher?
Right.
Thank you.
So, Bernard, I'll admit that this is one of those cases where uranium has been a very tough place to be, and Cameco has been a sort of chronically underperforming stock, really going back to 2007 when it peaked out. So, I haven't spent a lot of time looking at it, but here's my advice. When there are lots of companies doing well, and lots of sectors that people care about, to try and pick the bottom in something that's been falling for 10 years is a tough thing to do. So
it has been about 10 years. It's hard to believe.
It has been 10 years. You know, this was a $60 stock, and now it's $14. And so this has been in a pretty decent market. Now, we've also had a huge lift in energy stocks since February. And you might think that if that were the case, you'd get some follow through in some of these uranium stocks. Nothing. And nothing in solar either. So I would be cautious, and I just think that there's other things to focus on.
Okay, let's take another caller right now. Ed in Hamilton, Ontario. Go ahead.
Hi. I wanted to ask about Home Capital. I'm more of a short-term trader, and I was just wondering, in the short term, where you see this stock, and also, is this Fed decision that's coming up, I think, tomorrow with the interest rates, if that's going to have a short-term effect? Thank you.
Okay. So to start with, there's all kinds of concerns around lenders as it stands right now and their ability to make money.
I thought you were going to say the Fed.
Well, there's lots of concern around the Fed, but it's unlikely they're going to do something at this point. And in fact, that would probably be a good thing for some of these financials if people believe they were going to get a whiff of higher interest rates. Likely that would be a bit of a tailwind.
Okay.
When you think of home capital, they've done a very good job over time of managing their losses on mortgages. They've been very effective, but there are some real concerns about the Canadian housing market. And there are some concerns around some of the risks in Western Canada. And so I would prefer not to focus specifically in the mortgage market. The stock is not behaving particularly well, so that would sort of back up our view at this point until you started seeing it behave better, or until you thought you were at a point where you were going to start seeing rising rates. And frankly, the yield on a 10-year bond hit lows we haven't seen since 2012. So there's no sign that that's turning around in the near term. I'd steer clear of this space.
And not only just the space, David, but I mean, you do run quant models, you use technical analysis. If there was something interesting going on in the stock from a trading perspective, I would think it would show up on one of your daily screens and analysis.
So what we look for is we look for a change in behavior. And we're not seeing it at all in this space right now. So there's three places you get return. You get return by finding the right asset class, which we like equities right now. Geographically, we prefer the U.S. better than Canada. Second, you get it by finding the right sector or industry that people care about, themes that people care about. We're not seeing that in this case. And then we look at the price of the security. Is it behaving well relative to its peers? And it's really not right now. And then fundamentally, we're not seeing a driver. So all of those things would cause us to stay clear.
And the reason why I bring that up from the trading and quant perspective is because Ed did say he's a bit of a trader.
Yes.
All right. We're going to be back with David Burrows. He is President and Chief Investment Strategist at Barometer Capital Management, answering your questions about North American large cap companies. You can call us toll free 1-855-326-6266.